In today's video, I am going to reveal one of the best indicator for both scalping and day trading. I will also reveal a strategy that you can use with this indicator to make massive profit in trading. So if it is something you are interested in, kindly hit the like button. Also subscribe to my channel and turn on the notification bell to stay informed each time we make new videos. Now, let's get started. Buy low, sell high. As a trader, you always want to buy at a market bottom and sell at a market top. This is a market bottom as identified by this indicator. Let's take a buy and see what happens. Place a stop loss under the channel of the indicator. Target a 1 to 1.5 risk-reward ratio. Let the trade run. And it was profitable. Now, here's a market top, which means we're supposed to open a short position. Place the stop loss above the upper channel. Take profit at 1.5 times the risk. Let the trade run, and as you can see, the trade was profitable. Ladies and gentlemen, this is the Top G indicator by Big Beluga. It's a tool designed to identify market tops and bottoms, helping you to spot trend reversals with ease. Now, we're going to go over what this indicator is and how you can use it in your trading. To add this indicator to your chart, first go to TradingView, and then open any trading security that you like on any time frame. Next, click on Indicators tab and type in Top G Indicator. Then, select the one by Big Beluga. Now you may be thinking, what exactly is this indicator? The Top G indicator by Big Beluga is a technical analysis tool designed to assist traders in identifying potential market tops and bottoms. Its simplicity and focus on market extremes make it particularly useful for traders looking to time entries and exits in trending or ranging markets. As you can see, it's a super simple indicator made up of the following components. First, we have the trend channel. At the top of the channel, we have the upper band, and at the bottom, we have the lower band. At the center, we have the middle line. These bands serve as key reference points for analyzing price movements. They can be used to identify potential areas of support and resistance, helping traders decide whether to enter or exit trades with greater confidence. When the price approaches the upper band, it may indicate overbought conditions and a potential reversal or resistance zone. Conversely, the lower band signals oversold conditions and potential support. The midline serves as a dynamic equilibrium, helping traders gauge whether the market is strongly trending or consolidating within a range. The main components of this indicator are the top and bottom labels. This is the top label and this is the bottom label. Whenever you see this, it basically means the market is likely reaching a high probability top or an overbought zone. It signals a potential reversal to the downside, making it a good point to consider exiting long positions or entering short positions. This label is based on price action dynamics that indicate market exhaustion or resistance. On the other hand, at the bottom, we have the bottom label marked with the G sign. This indicates a high probability bottom or an oversold zone. It signals a potential reversal to the upside, making it an ideal point to consider entering long positions or closing short positions. This label reflects conditions like low volatility or momentum shifts, suggesting that the market may be preparing for a rebound. Then we have this caret and its inverted version. These are called intermediate signals. This one indicates potential bottom areas, but with less certainty than the G labels. These are secondary signals useful for traders monitoring reversal opportunities. On the other hand, this signal identifies a potential top area, but again with less certainty than the top label, providing additional context for traders trading in range-bound markets. Now, how can we use this indicator to trade? Well, I'll tell you. But before that, let's take a look at the setup and see how customizable it can be. On the Input tab, we have the length with a default value of 150. This determines the number of bars or periods used to calculate the indicator's range and dynamic bands. A higher value, like 150, results in smoother bands with fewer signals, as it captures a longer-term view of the market. On the other hand, lowering this value makes the bands more sensitive to recent price changes, generating more signals but potentially increasing noise. Here we have an option to change the main color of the indicator. For me, I'm going to leave it at default for better visibility, and the length is going to remain at 150. On this tile tab, I'm going to disable the midline for a cleaner look. After that, click OK. Next, let's add the MACD indicator, so we can cross-check the strategy. Double-click on it to open the settings. On the Style tab, disable the MACD line, as well as the signal line options. Then, click OK. Now that we've set everything up, let's go over the conditions for taking positions. The idea behind this strategy is to use the top G indicator to identify market tops and bottoms. Before taking positions at these tops and bottoms, we look for divergences on the MACD indicator as extra confluence. Now for a long position, you first of all want to identify a bullish divergence on the MACD. This unique type of divergence requires three things. First, you want to look for your initial MACD low forming a clear trough, and then let the MACD histogram move upward and create several green bars. After that, the histogram must form another MACD low with a series of red bars. You want to ensure that the first MACD low is lower than the second MACD low, confirming a bullish divergence. Now on the chart, you want to draw a line from the middle of the first MACD low to the middle of the second MACD low, and compare this to the price. If the price creates lower lows while the MACD shows higher lows, this indicates a divergence. Now within the divergence, you want to look for a G label signaling a potential market bottom and further increasing the odds of an upward move. Now once you see the MACD histogram turn green again, indicating bullish momentum, you enter a long position. Place your stop loss right under the lower band and set your take profit 2 times the risk. Let the trade run, and in this example, it turned out profitable. Now, how do we take a short position? Well, it's going to be the opposite of what we did here. Now, condition number 1 is you want to identify a bearish divergence. Here, as you can see, I've drawn it, and this is the explanation. The MACD created 2 highs with 1 low in between. The first high was higher than the second high, and while the price was creating a higher high, the MACD was creating a lower high, giving us a divergence. Now looking at this, we can see it's the exact opposite of the bullish divergence that we used for the long position. Once we have the divergence, we need to mark the beginning of it all the way to the end of it. And then in between these 2 lines, we need to look at the price and see if there is at least one top label printed. And right here, we can see a clear top label printed, indicating that the price may be overbought and due for a bearish reversal. Once this is confirmed, we just wait for the MACD histogram to shift to red to signal an increase in bearish momentum. Then, we take a short position, stop loss above the upper band, and take profit to be set at 2 times the risk. Let the trade run. And as you can see, it was profitable. In summary, the top G indicator by Big Beluga identifies market tops and bottoms using dynamic bands and labels. Paired with MACD divergences, it helps traders spot high probability reversals and execute trades with clear entry, stop loss, and profit targets. And that's been it for this video. I really hope you found some value. If you did, remember to leave a like or even consider subscribing to stay tuned. Thanks for watching. See you next time.